Time now for business, and I'm pleased to announce Kate Moody is with us. All eyes on America's central bank as it pulls away from the financial crisis and begins tightening policy.
It certainly is. Really not much suspense, though, as Janet Yellen made that announcement. The Federal Reserve confirming that it will lift interest rates for the third time this year to between 1.25% and 1.5%. Now, that level of the federal funds rate was cut to zero during the financial crash in an effort to encourage lending and spending. As the economy has returned to growth and the unemployment level has dropped, the Fed has begun gradually lifting interest rates, even though inflation remains below its 2% target. The Fed laid the groundwork for 3 more interest rate hikes in 2018, rather than the 4 that had widely been expected for next year, even as it boosted its forecast for GDP growth. Janet Yellen, meanwhile, holding her last major press conference before she steps down in February. The Fed chief said that low inflation does remain a serious risk.
There is uncertainty about what's holding inflation down, but my colleagues and I continue to believe that the factors that are responsible this year for holding inflation down are likely to prove transitory. That said, we recognize that there's been a prolonged shortfall.
Earlier, I spoke to Randy Krozsner, former Federal Reserve governor from 2006 to 2009, now the economics professor at the University of Chicago Booth School of Business, to get some of his insight about what this move says about the state of America's economy.
It shows a confidence that the Fed has in the economic recovery. We've now been growing over the last couple of quarters at about 3% rather than around 2%. Inflation is still below the 2% target. But I think it shows that the Fed thinks that the economy is strong enough to try to regularize rates even before inflation gets up to its goal of 2%.
The federal funds rate, as you said, does remain fairly accommodative. Is this a new normal for monetary policy in the United States?
I think it's likely that interest rates are going to be lower going forward than they have in the past. I think there are a few reasons for that, one of which is because people have much lower expectations about inflation. There'd been much more of a risk of an upside to inflation. Now we don't seem to have that in the U.S. and really don't seem to have that in Europe either.
Now, the central bank does tend to distance itself from political developments, but as a former Fed official yourself, you must know there must be some discussion of the economic impact of certain proposals, things just like the Republicans' tax reform plans. What's your assessment of how this bill might affect future decisions?
So I think as Jay Powell, the person who the president nominated to replace Janet Yellen, had said in his confirmation hearings, they will probably do the analysis after, or they not only probably, they will do the analysis after the bill is passed, because we're still not sure about all the pieces. But I think undoubtedly, given what we do know about it, it will be positive for 2018, and the Fed will take that into account when it's doing its policy next year, that this may help to boost growth further beyond perhaps even 3%.
Reports suggest Republicans in the U.S. House of Representatives and the Senate may have reached a tentative deal to combine their 2 versions of that tax reform legislation. Donald Trump has said that lawmakers are very close to what he describes as a historic legislative victory. He suggested that a breakthrough was imminent.
Now we're just days away, I hope, you know what that means, right? From keeping that promise and delivering a truly amazing victory for American families. We want to give you, the American people, a giant tax cut for Christmas. And when I say giant, I mean giant.
Let's check in on the markets now. Investors had already priced in the Fed's interest rate hike. The market reaction was fairly muted, overall positive, although we did see the S&P 500 dropping slightly to close just under the flat line. The Dow Jones jumping on reports that tax overhaul may be making progress in Washington. The major European indices finished under pressure. The CAC 40 and DAX each losing about half a percentage point on the session. Anyone who uses Uber knows that surge pricing is every rider's worst nightmare. But one man in Canada had a particularly bad surprise earlier this month. His 20-minute ride during rush hour in Toronto wound up costing him over 18,000 Canadian dollars. That's over 12,000 euros, 14,000 American dollars. He struggled to get a response from Uber in the aftermath to that ride. His plight did gain traction on social media, though, And the ride-sharing firm eventually issued a statement apologizing for what it described as human error and refunding the price of the ride. It certainly is bad press for Uber, and at a particularly bad time for it. Its US-based rival Lyft has just recently launched its own service in Canada. And Mark, the man affected by that particular ride, has already been tweeting, wondering how Lyft would have dealt with that situation.
Indeed. Kate, it sounds like a good time to buy a bicycle. Kate with the business there.